So we are so excited to have Barb here with us tonight. She has been a speaker at a couple of our events and is always, everybody always asks for her to come back and talk again. And usually by the end of the evening, we still have more questions to ask Barb, but we've run out of time. So I wouldn't be surprised if that happens tonight. But this is our 8th virtual information forum. And what we've done over the past year is we have brought you all together to talk about hot topics. And we started with COVID-19, and at the beginning of last year when it just hit, we had the chief nursing officer from Virginia Hospital Center come in and give us an update. We had the executives from the NAACP branch come in and talk to us about things that they were doing in the community after the protests. We've talked about solar power, distance learning, building confidence in yourself, fitness and nutrition, and we'll continue bringing these hot topics to you. And of course, we always are here to talk to you about real estate, but we also want to share the expertise of others with you that is related to real estate as well. So we encourage your questions, as we mentioned. And just so I can introduce Barb to you, she is a senior accountant at Cherry Beckert LLP and has worked in tax services and accounting consulting since 2007. She has very deep expertise, and we have challenged it several times with a number of questions, and she never lets us down. She always knows the answers. She's worked with a number of small businesses who need consulting services, accounting services, and tax services. And prior to joining Cherry Beckert, Barb was an accountant with a Rockville-based company called Berlin Ramos and Company. So we are delighted to have her here. She will make sure that all your questions are answered, and she's going to give us an overview, and then we'll jump in with the Q&A. So thank you, Barb, for being here.
You're welcome, Marybeth. Thank you for such a nice glowing introduction. So, hi, everyone. I'm going to preface this by saying that all of this is just general tax information, and we're going to talk about a lot of topics, and I'm happy to answer questions, but there's a lot of nuances to tax. So this is just some general guidance, and anything specific would be a separate conversation that relates to your specific situation. So to start off with, the CARES Act. This is a big change in 2020. It's the legislation that was signed in the spring when the pandemic started. It covers all of the stimulus payments that people have been getting. It covers things like the PPP loans that go to businesses. There's changes to retirement distributions. There's changes for charitable contributions. There's just a lot happening here. So the highlights of this, when you're filing your 2020 taxes, everyone's real excited about the stimulus payments. If you feel that you were due a stimulus payment and you did not receive it, whether it's the first one that came out last spring in the late April, early May timeframe, or the second one that was just done in late December and early January, if you didn't receive that, or you got just a partial benefit and you feel that you should have gotten more, there's a reconciliation feature on the 2020 tax return that lets you true that up. And when I say you might be entitled to a different amount, the IRS sent all of those payments based on what people filed on their 2019 tax returns. If your income changed and it dropped in 2020, the payment you got might not have been correct. Maybe you're due more money. You can apply for that and get that refunded to you. So that's something to keep in mind as you're doing your 2020 return. Additionally, for people that don't itemize their deductions, generally, if you make a donation to a charity, you don't get an additional benefit for that. For 2020, you can actually take a page 1 of your taxes special charitable deduction of up to $300. If you gave money to charity and you already take a standard deduction, you actually can claim $300 of charitable deductions on your return. So that's another thing to keep in mind. Other things to think about, retirement withdrawals. If you are of an age where you need to take distributions from a retirement account, in 2020, you did not have to take one. So if you forgot to do it, don't worry about it. There's no penalty. If you took one, you did have the option of putting the money back into your account within 60 days and not having to claim that as taxable income. Nothing that can be undone now, but if you didn't take it in 2020, that's absolutely fine. Other things with retirement accounts. In 2020, the CARES Act said that you could, if you were suffering a financial hardship because of the pandemic, you could take up to $100,000 out of a retirement account as a one-time distribution, no matter what your age is. And if you're under 59 and a half, the benefit there is that you don't have to pay the 10% penalty on that. The benefit to everyone, whether you're 35 or 85, is that if you took money under this hardship withdrawal, you don't have to pay the income tax in 1 year. You can stage it over 3 years to kind of lessen that burden on yourself. So that's another thing to keep in mind for anybody who took one of those hardship withdrawals. Other things just to keep in mind with taxes, maybe ways to save a little bit of money, is to make an Ira contribution. If you are getting ready to file your taxes, you don't participate in a retirement plan with your employer, you have until the day your tax returns due to make a contribution to your IRA. And as long as you're not participating in a retirement plan, you can contribute $6,000 if you're under the age of 50, or up to $7,000 if you are over the age of 50, because there's a special little catch-up provision. One of the other things to keep in mind there is there are also some provisions where, depending on your income, even if you're participating in a retirement account at your employer, sometimes you can also put money into an IRA or into a Roth IRA to have additional tax, either tax benefit or tax deferred retirement savings. All of those are indexed to your income. And once your income is over a certain threshold, you can't do that. But again, that's a specific person-to-person situation that would need to be discussed offline. But those are just some things that you can do to give yourself more retirement savings. And it's a tax planning thing you can do now because you don't have to have done it in 2020. Other things that might be important for 2020, if you have kids in college and you have moderate income, you may be able to claim some college credits, the American Opportunity Credit, or some lifetime learning credits. They are used just for college expenses, and the rules for how you claim them vary depending on the credit, but there are some tax credits out there for education, especially for people in a moderate income bracket. And I say moderate because this area, you know, it's a fairly wealthy area. There's a lot of dual income families, and a lot of these thresholds are set by the average income in the United States. The average income in this area is higher than the national average. So there's a lot of these things that people may or may not qualify for, but I just mention them because it's important to know they're there. At least ask the question when you're doing your taxes to see if it's going to be something you're going to benefit from. As far as, itemized versus standard deduction, we do have that new limit. It went in 2 years ago on state and local taxes in this area. State and local taxes now as an itemized deduction are limited to $10,000. I say in this area because the average property taxes in Arlington and Fairfax County can quickly get close to $10,000. We pay vehicle tax on our cars, personal property tax. So it's entirely possible that your real estate taxes and your car tax are going to hit that $10,000 threshold. And that doesn't even include the state income tax that's coming out of your paycheck or the estimates that you're paying when you're self-employed. So that is just something to kind of keep in mind, because when you have a itemized deductions versus standard deduction, the standard deduction threshold is so much higher now. For a married couple, the standard deduction is, I'm thinking it's $24,600, $24,800. It's a substantial amount of money. So when you can only include $10,000 of state and local taxes, if you don't have a mortgage, you're probably not going to hit that number unless you have had a medical situation and you've got a lot of medical deductions, or you know, maybe you had a wonderful year and you made a lot of charitable contributions, but there's a lot less people that actually get to use the itemized deductions now. Nationwide, literally 85 to 90% of tax filers now claim the standard deduction because it's easy and it's more money than what their itemized deductions were. But that being said, it's also why that extra $300 of charitable contributions can be really important for people. As far as, you know, like general questions, you know, that kind of covers high level topics. So I'm curious to see what sort of questions people have now. Does anybody want to, you know, start off with a question, or we've got a couple ideas of just general additional topics?
So I have one to kick it off is,
Okay.
so if you're retired, can you still donate? Can you still contribute to your IRA?
That is something new, and as long as you have earned income, there is no longer a limit on the age that you can contribute to your IRA, but you have to have earned income. So when you say retired, if you're retired from your original job, but you now have a side business and you're earning a couple $1,000s, you can still contribute to an IRA at any age. That is a brand new thing. It used to be once you hit the age of 70 and a half, you couldn't contribute to an IRA anymore.
So, but what if you're pulling it, if you have a pension?
It's not earned income.
Okay.
It has to be earned through a job. So pension, Social Security, interest, dividends, capital gain on an investment account, those qualify, or those do not qualify. It has to be earned income. And it can be from just a little job that you do 5 hours a week, but it has to be earned income.
Can it be something as, I mean, is there a limit on, is there an amount that you have to earn in order to be, can you earn $2,000 and still make a contribution of 7 or 6?
No, you can't, or you cannot contribute any more than you earn. So if you earn $2,000, you can contribute $2,000.
Okay.
So yeah, but it's actually an interesting little planning tip for kids. If anyone has kids who have a summer job that they don't need to, you know, they don't need all of that money that they've earned and they want to, you know, save some of it, you can have kids put money into an IRA or a Roth IRA when they are 16, 18 years old. And when that sits and grows for 50 or 60 years, they will be really happy to see how much money has grown.
That's
so
great.
it is something that, you know, it's a great way to teach kids to start saving money.
Yeah, definitely. Definitely.
But it does have to be earned income.
Okay, that's a great distinction. Welcome, Mavi and Jim. Robin, you have a question, or Vivian?
Yeah, my question is sort of a general clarification. When you, on your investment, when you receive 1099 INT or 1099 DIV or 1099B, and that states that the proceeds are not reported to the IRS. Now, what does that exactly mean? Is that those proceeds are reportable, taxable, or not? if
Okay.
they're not reported to IRS. Well, that's a little bit confusing. Why they don't report it?
Right, okay, understood. So anything that you receive on a 1099 form is something that you have to claim as income on your tax return. The reason that some things, especially on a 1099-B, which is the form that lists securities that are bought and sold, sometimes says not reported to IRS, is related to how the brokerage firm is required to report it. And it's frequently indexed to when you bought the security or what they know about your cost basis. That 1099s for short-term and long-term capital gains have classifications of A, B, and C. If it's an A classification, they report how much you sold it for and how much you bought it for and the dates and all information's on the proceeds to the IRS. The IRS expects to see the exact same information on your tax return, and they use computerized matching systems to match it all up. 1099-B are things where they report the proceeds, but they aren't required to report the cost basis because for some reason they may not even have it. So if it says that it's not reported to the IRS, it's only because the brokerage firm doesn't know what your cost basis is, so they don't know how much your gain is. So you are responsible on your tax return on Schedule D to descriptively write, fill in each security that you sold. So if you sold 100 shares of GE for, 100, I don't know what GE is trading at, but let's just say $50,000, you have to tell the IRS, and I bought this in 1998 for $3,000 and my gain is this much money, because the IRS doesn't know. They just know that you made money, but they don't know what your cost basis is, so they don't know what the tax consequence is. So it's a little bit more work on you, because you have to find your records for how much you originally paid for those stocks.
Well, that's interesting for me to know, because the investment company doesn't know the cost and don't give you the whole information. That's kind of, the investment starts with them to start with, the cost and all that.
Mhm.
So in other words, what you're saying is that whatever information is provided on 1099-B is to be reported on Schedule D.
Yes, that is correct. If it is on 1099-B,
Yeah,
it goes on the Schedule D.
D, okay, all of that information, okay.
Yes,
Now,
yes.
the follow-up question is another one. Also, 1099 DIV reports non-dividend distribution.
Mhm.
Non-dividend distribution. Is that taxable and reportable, that amount?
There will, in tax software, there will be a field to input it as just an informational item, but it is generally not taxable.
Okay,
It's a distribution that reduces your cost basis of some security.
okay.
So if you're not using tax software,
If you're not using tax software, I would not worry about reporting it.
Okay.
You do need to keep track of it. There should be details in the back of the 1099 form as to what it pertains to.
Yeah. Also, one more item that I noticed is the under 1099 reconciliation and fees expenses.
Mhm.
Under miscellaneous expenses, there is an amount.
Mhm.
Now, is that amount, in your opinion, deductible on Schedule D? Miscellaneous expenses related to investment.
Right. Typically, the miscellaneous expenses are no longer deductible. Prior to 2018, I think it was, they were deductible on Schedule A as a miscellaneous expense because you
Oh,
even be able to deduct tax prep fees and the cost of your safe deposit box and things, but that has gone. There are some cases where states will allow you to deduct some investment fees, but that would be the only time that it would be of benefit. There's no deduction on the federal side anymore.
would you know if Virginia does that, allows that?
Virginia does. I believe they do have an additional subtraction. I would have to look at the form to tell you what line it was on. But I believe that Virginia and Maryland both do allow some investment fee deductions. They, it's, the Virginia form will always have additions and subtractions from your federal income that you have as an adjustment. And so it would be an additional subtraction.
Okay, okay. Now that I don't want to take too much of the time, but now that I have your attention, what about 1099 OIDA? The original discount adjustment, is that reportable, taxable?
It can be. So OID, yeah, it's the original, let's see, I'm trying to think, original interest or original interest discount. It's,
Yeah, original discount and adjustment interest, yeah.
yeah, and it relates to the interest income that you get from bonds. If you buy a bond for less than its par value, you have the original issue discount.
Okay,
And there's tax adjustments over the course of time to that bond and what interest you do and don't have to report. Generally, if it's a municipal bond, because those are, and it's like, if it's a Virginia municipal bond, that's tax exempt in Virginia and it's tax exempt federally. So it's a non-tax issue for you. If it's an out-of-state bond, if it's a Maryland bond, you may have a small tax adjustment to make for that.
but the thing is, they don't really specify which state. So that
Oh, so that you would have to find the, if you hold a lot of bonds, you would have to look at all of the original purchase information to see which ones were bought below par to figure out what state it might apply to.
I think these are bond funds. I don't
Oh.
have individual bonds. They're through an investment, so how they
Yeah, okay.
divide your, mix up
Yeah.
your investments. Yeah.
Okay, so that, it's funny, I mean, because I'm so used to using tax software that knows where to plug it in the right place. It would be an adjustment to the interest amount. And as to where it was reported, I think if you're just manually filling out your tax return, you would just adjust the interest amount. But if it's a bond fund, if it's depending if it's taxable versus non-taxable, there's the taxable interest line, there's the tax exempt interest line. On Schedule B, you're listing out, each particular fund and where the interest and dividends are coming from. So it would be something you would adjust there.
okay. Just quick question. We were talking about Schedule D. Would you say it's advisable to attach a copy of the 1099B along with the Schedule D when you filing your tax return to provide where you getting your numbers from, your figures from?
Right. You can, so if it is something that is listed under this section that says that the information was reported to the IRS, it's kind of moot as to whether you would include that, because the IRS has already received all of that data electronically and they'll be looking for it. If it's in the section B or C where it says that not all of the information was provided to the IRS, you could attach it because it would provide
Okay.
additional meaningful information.
Right, yeah, because it does say it's not provided, proceeds are not provided to IRS. So it would be advisable to attach a copy of 1099B.
Yeah, it's helpful. I mean, honestly, we attach electronic Adobe PDF copies of some of these things into returns that we electronically file because it's always nice to have that corroborating information.
Yeah,
It's the section A where all information is provided. You don't need to give any additional detail because they already have it.
yeah. I think we'll go ahead and provide it. I'm an old school, so I don't really, I file it manually. Let me put it this way. So I'll go ahead and attach that. I have done it in the past.
Mhm.
There hasn't been any questions so far.
Right, okay. So you've got a good system.
Right. Yeah,
Okay,
Robin,
thanks so much.
I'm sure you're not alone in that, in doing that.
Thank you.
Alicia, did you have a question?
Yes, I did. Thank you so much for this. This is very interesting. I actually wanted to ask a question for my mom, who
Okay.
retired, but she purchased property back in May and
Mhm.
then was able to pay it off with the proceeds from the house that she had lived in for many, many years here in Arlington, she downsized to a condo in Arlington, thanks to Marybeth. And I had a question about capital gains and what that might look like for her.
Okay. So as long as she has lived in the house or what she sold for at least 2 of the last 5 years, which sounds like she easily met that, then she can exclude up to $250,000 of the capital gain.
Okay.
If her gain was less than $250,000, nothing's going to be taxable. If it was $260,000, $250,000 will be excluded and $10,000 difference will be taxable.
Okay. Are there income thresholds or age thresholds
No.
related to capital gains? No. Okay.
No, not right now. Everything could change. The capital gains tax rate is actually also tiered. So depending on her income and what her gain is, there's actually a 0% capital gains tax right now for people that are of a lower income. Some people pay 15% and some people pay 20%. But the 20% is the highest capital gains rate right now. It used to be a lot higher.
Okay.
So Bart, how would you pay 15% then?
I'd have to look up let me see if I have quick access to the income thresholds because it is indexed to your taxable income. I would say the average person in Arlington is probably paying the 20%. If you bear with me, I can see if I can determine quickly what the 15% rate is, because honestly, I don't see it very much. The people that I see it for are young adults who are just starting out. They have their first job. They just worked part of the year. Maybe they earned $35,000. They get their standard deduction. Maybe they have, $2,000 of capital gains and a little bit of interest in dividends. They might end up in the 0% bracket or the 15% bracket, but bear with me and let me just see if I can get this real quick.
Yeah, that would be great. Thank you for looking that up. I appreciate it. Because, without going into too much detail, she lives off of her retirement and was fortunately able to make enough on the sale of the house to pay off the condo. But I know she was worried about capital gains, which is why I'm asking.
Right. So
She's a numbers person, right, Alicia?
Yeah.
Yeah.
Yeah, she's way smarter than me, particularly with money and investments. Yeah.
Yeah.
Yeah, yeah, that was very interesting. I just wanted to mention, if I'm right, when you do the worksheet on capital gains, wouldn't that lead you down the line and let you know whether it's 15% or 20% on the worksheet?
Well, yes, when you go through the entire worksheet in the tax
Right.
return, it will tell you that, yeah. I'm just looking to see if I can quickly come up with a table that shows what the rate is for single people. So for, let's see, for single people under $40,000 of income from any source, they would be eligible for the 0% rate. The
For
fifth
zero
for
capital gains?
zero, right? So
Wow,
that's why.
okay.
So that's why a lot of young adults do end up with the 0% rate.
Wow.
For single people, let's see, there are situations where you could have as much as it looks like, and I'm reading this and thinking I have a hard time believing this, but you could have as much as $400,000 of income and still potentially qualify for the 15% rate.
Okay.
So that's substantial income, and the gain is going to be calculated in what her income is. So it's one of these sort of circular calculations. Another thing that she might want to keep in mind is that in a year when you have capital gains, if your predominant income is from Social Security, it may suddenly make more of your Social Security benefits taxable. If you are getting less than, I think it's about $23,000 from Social Security, you may not need to pay tax on that if you don't have any other income. But if you suddenly have a lot of other income, as much as 85% of your Social Security benefits can sometimes be subject to income tax.
Wow.
So, and all of this varies because you could have somebody one year who had minimal interest and dividend income and no capital gains, and they lived off of their Social Security, and then something happened, they needed to sell a lot of stock, they suddenly have $50,000 of taxable gain, and now that's taxable, and their Social Security benefits are taxable. And the Social Security benefits are taxable as ordinary income. It's not like that's a capital gains tax. And then they could go the next year back down to the original and not having anything be taxable.
Okay. That's really helpful. And then my other question, and I recognize that we've got tax experts and people that do their own taxes. I'm not one of those people. Until particularly this year, I had used some tax software in the past, but this year and last year, I went to a tax preparer, and I was late to the game, and a lot of people were not taking on new clients, and I ended up filing my state taxes late, which is I'm not one of those people most of the time. So I'm hoping you can give me some insight on how to find a good tax preparer and what sorts of things I should be looking for in a tax preparer. And just so you have a little bit of context, I went to someone and my mother also went, and we both had our taxes filed by this individual. And the majority of the time was spent trying to convince us to give him money to invest. And the taxes part of it sort of fell by the wayside. And while everything did get filed, we both would like someone to review last year's taxes to make sure that they were filed correctly, but also to hopefully not repeat the same mistake and go to someone that may not be as scrupulous as we would like.
Right. Okay. Wow. That's I will admit that is a situation that I have not run into before, because generally a tax preparer is somebody who is a CPA or an enrolled agent, and so they have a professional credential that they have a certain level of knowledge related to taxes, and that is their predominant market. People who are investment advisors have to have a completely different set of licensing. And the
There you
two
go.
of them don't cross frequently. You may have somebody in a firm who does tax prep and somebody else who's an investment advisor, but to have one person performing both roles is pretty unusual. So you would want to be looking for somebody who was a CPA or an enrolled agent. You want to see that credential on their website, their business card, whatever marketing materials they have. Those would be important. Other distinction with those is that those two or an attorney are the only people that can represent you in front of the IRS. So if there was a question about a prior year's tax return, you could grant one of those people a power of attorney to contact the IRS on your behalf and talk through everything that needed to be done to sort out the issue. But you can't give that authority to an investment advisor. So that's one of the reasons why that a credential is important. You would also want to look for somebody that is just using a, an hourly rate or a specific fee for service. You don't want somebody who's doing a contingent fee that is based on the amount of your refund, because they're going to be pushing you to look at tax deductions that really aren't legitimate deductions potentially. So that would be something that you want to watch out for. I mean, I'm happy to talk to you about the types of services that my firm provides, but it may also be something that's a little bit more robust than what you're particularly looking for right now. I'm just thinking, I mean, if I was looking, I would also just talk to my friends and neighbors and get a referral for somebody that does tax work that they've been happy with, because an awful lot of people do outsource their tax work because, it's nitty-gritty details, and a lot of people just don't want to get bogged down in it, or it's kind of scary because the IRS, people think, oh, the IRS, that is the last agency that I want to get on the wrong side of. So referrals from friends and family and neighbors is also a good way to go.
And actually, I'm probably one of the few people where the IRS has been very nice to me when I've goofed up. So, but good questions, Alicia. Jim, you have some questions, I believe.
Yes, I'm here. Sorry, I'm in my truck, so if anyone's watching my video, it's bouncing all over the place. I apologize. I have a couple questions. One of them following up off of Alicia's question regarding capital gains. So, Marybeth helped me sell my first property this year.
Mm-hmm.
What paperwork do I need to maintain, and for how long do I need to maintain it for that capital? I mean, to say that I want to owe capital gains up to the 250. And I know that the money you put into the investment gets subtracted out from what you recoup, right? So I just want to make sure that I'm keeping the proper documentation so that the IRS doesn't come back to me and say you made a sizable gain and didn't report any of it. I've never had to report it before, so I don't really know what the process is going to look like yet. Right.
Okay. So another distinction there with the reporting is if it was your personal residence, then it's, it's a different sort of reporting than if it was an investment property. But as far as things that you're going to want to keep, the settlement paperwork from the original purchase, the settlement paperwork from the sale, you're going to likely get a form 1099-S, S as in sale. That form needs to match what's on your tax return, or there needs to be a really logical reason that it doesn't. So if you actually split it with somebody, you report it, and then you report the part that somebody else reported. You want to keep all of it for a minimum of 3 years, but ideally more like 7 years, because if the IRS comes back and they question something on a prior return, if they feel that there was an error, they can potentially look back a little further. So I always tell people just go with the 7 years. you know, and it can be a scanned copy. You can stick it all on a flash drive, scan it to your computer, upload it to the cloud. As long as you can find it, it doesn't need to be the original signed and stamped paperwork.
So if when I sold it, I was collecting rent on it and not living in it, I lived in it. It was my primary residence for 2 of the past 5 years, but not in the last year that I was there. And in part of the 2 years that it was my primary residence, it was under construction.
Okay, so as long as you lived in it for 2 of the 5 years, you should be able to exclude $250,000 of gain.
What if I didn't live in it, but I was paying the taxes to the District of Columbia? While it was
So
under construction?
where were you living? You were getting your mail and you had your driver's license at a different address?
Driver's license and mail were going there, but it was not livable for the first years. But I was
Okay.
paying the taxes and treating it as if it was the primary residence, and I was living for free with a friend for that time period. So there's no paper trail anywhere that said I was anywhere else, but it was definitely under construction for that first year.
Yeah, so if it's under construction, but it was intended to be a residence, I think you could still get away with the primary residence, but you mentioned that you were renting it. So you also at one point were claiming rental income.
I lived in it. I bought it with a friend. We rebuilt it. We gutted it and rebuilt it. And we both lived in it for a period of time. And then I moved out and rented out my half to him and his girlfriend until he bought me out.
Okay.
So it was intended to be a primary residence and a major falling out between me and him, which led to him buying me out. But in the meantime, it led to me having to move out and buy another place. So I had another primary residence that I bought over the last year. I mean, I think I just need a good accountant, but I'm
Right. So I think that there is reasonable basis for calling it your primary residence. The fact that you moved out of it for a little while and then rented it for a bit may add a nuance, because when you rent a property, you typically take depreciation expense on it, and depreciation expense, even when you sell it as your primary residence, you have to pick that up again as ordinary income. So if you claim depreciation in the year that you rented it on, say it's on the 2019 tax return, then you can sell it in 2020. You can potentially exclude your capital gain, but the depreciation piece of it, you're going to have to pick up as income, and there's no way around that.
okay.
So that's going to be one where it depends on your specific situation, because it would require looking at prior tax returns. That's not something that is real easy to answer right now.
It goes back to Alicia's question of, does anybody here recommend a good accountant? Because I couldn't find anybody last year when I was dealing with this, and ended up doing it myself. But I don't trust using a program this year, given all of this. And yeah.
Yeah.
I have another question for you though. So as I said, I own a condo in DC.
Mhm.
If I'm getting transferred to Puerto Rico, my question is, if I rent out my condo in DC, will I still owe taxes to DC? And how does that work, I suppose? I mean, the taxes for Puerto Rico are very different, and there's a lot of incentives, and there's apparently no capital gains down there, but the condo that I bought last year or a year and a half ago would be would be excluded from that. So I just don't want to keep the condo and rent it out here if I'm going to end up owing significant taxes, because there's no way I'll be able to get the rent to match
Okay.
everything that I think I would have.
So the short answer is that if it becomes a rental property in DC, you absolutely will still have to file a DC tax return. You will have to file a special DC tax return, not the standard DC resident form D40. You have to file form D30, which is a franchise tax return. You put on it only the rental income and then the associated rental expenses, and DC will always charge you a minimum of $250 flat tax rate, but if you have taxable income, you will owe income tax to DC every year. Yeah. And
Is there
then,
a chance that I would owe it to both DC and Puerto Rico then?
no, because Puerto Rico, I will preface this by saying I haven't actually had to file Puerto Rico as a territory or state or how you want to call it. But the states typically will let you apportion your income. So if you have, let's just say you have $100,000 of income, 80,000 of it is attributed to Puerto Rico, 20,000 to DC. You actually do split it and you're not paying tax on both of them. Some states apportion it, some of them give you credit for the tax paid to the other jurisdiction, but you don't end up paying tax twice on the same income.
Okay. That's great. And then last question, I apologize to everybody else.
That's okay.
Do I owe tax? And again, my ignorance here is beyond control. So thanks for everybody for bearing with me. I sold that house. I signed the paperwork, and correct me if I'm wrong, Marybeth. I signed the paperwork in December, but I didn't get paid until January. Is it based on when the closing occurred, or is it based on when I got paid?
It's based on when the closing occurred. So if you signed the paperwork on the 30th of December and you didn't get the wire transfer for the money until the 3rd of January, it is a December 2020 taxable transaction.
Okay. Thank you
And
very much.
That's a good question. Yeah, because, yeah, I hadn't thought about that. So thanks for that clarification.
Yeah, no, that's a great point.
Yeah. And Jim, yeah, there is a lot going on in that transaction.
Yeah. I have to say, this is an amazing forum. So thank you very much to both of you for doing this. I jumped on late, but I very much appreciate it. I'm enjoying hearing the other situations too. It's very informative. Thank you.
Yeah, no, you're welcome.
And we're glad you could join us, Jim, because I know there's a lot going on when you're transitioning to Puerto Rico for your new job. And Jessica gets a big thank you for organizing this for us. Mavi, do you have any questions you want to ask? Or Jessica, do you have anything you want to ask?
I do. I'm turning my camera on. So this isn't really a question for me, but I know it's a question for a lot of my mom friends who have now transitioned over this year from in-office working to home office working, and that can affect any of our deductions or how we file our taxes. I'm assuming no, but that may come next year. Maybe they'll figure it out, but I'm wondering if there's anything that can be deducted, or itemized.
Right. So the typically no. As long as you're receiving a W-2 from your employer, you don't get any advantage of a home office deduction or a deduction for using your cell phone for work now, your home internet. If your employer isn't giving you an allowance for it, you're not getting to claim anything. So you get no benefit. On the flip side of that, if you aren't a W-2 employee and you're self-employed, you file a Schedule C, and maybe you previously used to go to a lot of client sites, or you were out and about all the time and you never really needed a home office, and now you're home all the time working and you have a home office. You can only take a home office deduction if it is a dedicated space for work that you don't use for anything else. So I've used this example for people before. You set up a corner of your guest room and you call this my home office, but various times people visit and they're using the guest room as a bedroom. That isn't a home office. It has to be an area of your house that is only used for work. And there's no rules in the pandemic that have made this any easier for anybody.
That surprises me. But so this allowance that you talk about, that some employers might be giving, does that count as income, or?
It depends on how the employer is set up. Typically, it shows up on your W-2 as an allowance. And typically, if it's just a small amount, it may not be taxable to you. On the other hand, it may have tax implications, but it'll be spelled out on your W-2 if they're going to add it into your compensation. I'll be honest with you, I have not run across a lot of employers that have done that.
Yeah, that, when you said that, I was like, ooh, is that a thing? Because that doesn't sound.
Yeah, it's typically companies that have a lot of people in sales give people like a car allowance or a travel allowance and those sorts of things. And they all vary, but there have been very few changes in the pandemic. This is just something we all have to kind of roll with.
It is. And that's something, interesting when you talk about self-employment. I know this affects me. So, I have self-employment income, but I have a lot less expenses because
Yeah.
there's less travel, right?
Mhm.
There's just a lot less expenses when it comes to working from home. So hopefully
Right.
maybe next year they'll give us some sort of benefit for that.
A COVID benefit, Jessica, is that what you're saying? COVID,
So people are at home more, so they're using their heat more. They're using their, internet you probably would pay for anyway, but maybe some people had to get internet so they could work at home. It's just the way what it is, or upgrade their data. So now because now the whole house is on Wi-Fi all day long, right?
Mhm.
So there are cost implications, although we probably are saving a lot of money because we're not doing anything. We're spending
Right.
money.
Not having the lunches out, not paying for the dry cleaning, all
Right.
those kinds of things.
Right.
Yeah.
yeah, the offsets.
Yeah.
I love this conversation I heard. I think it was on the news. He goes, yeah, I'm doing this interview and I've got 4 kids on Wi-Fi behind me. So we're hoping for the best.
There are times where I'm like, everyone turn off your Wi-Fi. If you don't need it, turn it off. That's actually, it is a thing we say quite often.
Right.
The interview went off without a hitch, but it was just so funny as he's speaking, he goes, yeah, and I got 4 kids on the internet right now. So we may stay up, we may not.
We don't know. Just gotta cross our fingers and roll. So
Yeah, so there was a question about raised income brackets, which I'm not exactly sure what the context is. Were there
Yeah.
raised income brackets that passed with the new legislation, or was it something that was on your mind? I mean, that passed with the tax bill, the Trump tax.
yeah, I'm not sure. It may just have been, do we expect a raised income bracket?
Oh, in the future,
So-
do we expect the Democrats to raise taxes in the future?
Well, I think, okay, go ahead. Sorry.
Yeah, that's so hard to say because, we don't know how things are going to end up turning out with the pandemic. I mean, certainly they're not going to raise them right now, but at some point, I think it would be short-sighted to think that there won't be an increase at some point because eventually all of this stimulus is going to have to be paid for somehow. Whether it's a change to the corporate rate, the individual rates, the changes in deductions, there's going to be something. As to when it is, I don't know. But for right now, for 2021, the tax brackets are the same as they were for 2020. So they actually will slightly, and I mean really slightly, just like 1 or 2% tweak the dollar amounts in each range. So you might have like an extra $1,000 or $2,000 in a lower bracket before you jump into the next bracket for 2021. But as far as the standard brackets, they're exactly the same as they were last year.
Okay, so no shift there. Mavi, did you have any questions? It's nice to see you.
Yeah, sorry, I was on my way back from my other job, but I was actually wondering, I just graduated in December from Florida State, and it's kind of coming at me real quick, like this whole big girl and like job and accounting and just not using Credit Karma for my one W-2 that's like a couple $100 at the end of the year. So I was wondering what you recommend and what you kind of, if you do have kids, what you recommend that they do once they reach a certain age.
So as far as recommend what they do, so that's kind of a big question. I mean, in general,
Sorry, yeah.
no, that's okay. So, I mean, in general, you need to, first off, think about setting up some savings for yourself, a little bit of emergency savings. If you have school loans, paying those off, because right now you can get some deduction for student loan interest, but that could eventually go away. Now, right now, student loans are actually kind of on pause, but eventually you're gonna have to start making payments. And if there's interest, you get a deduction when your income is moderate, but once your income goes above $90,000, I think it is, you no longer get deductible interest. So you want to pay those off quickly. You want to, if you have the option to participate in a 401k or some kind of retirement account, you do want to put a little bit of money into that, ideally enough that you can get the matching contribution, because there's this thing called the rule of 72, which I don't know if any of you have heard of it, but it's like how quickly your money doubles. So if you get 8% interest, your money's going to double every 9 years, because you take 72 and you divide it by the interest rate, and it tells you how many years it takes to double something. So if you get 10%, it's going to take you 7.2 years. If you get 8%, it takes you 9 years, etc. So, you know, you're young, you've got so many years till retirement. Yay. So the more money you can put away now, it will be so beneficial in the future. And you won't suddenly think when you're 55 years old, my gosh, I've got to start saving $25,000, $30,000 a year because I didn't do it earlier. So I would certainly do that. It's, you know, just really also with your paycheck, making sure that your withholding is appropriate so that you don't get a tax bill later. A lot of people fill out the forms and they just say, oh, 0. And then they think, oh, well, no, I have myself and I have this. So then they start claiming all of these adjustments, and then they realize they didn't have enough tax withheld and they owe the IRS money come April, or the state of Virginia. So that's another thing to be really careful about.
Oh, no.
Yeah.
Uh-oh.
Uh-oh.
Yeah.
Hey, Barb, thank you.
I'm not sure what happened there.
Yeah, no, I did that, exactly that. So yeah, that's very good advice to make sure you're having the right withholding, because
Oh, okay.
yeah, we got to the tax year and we're like, oh my God, what
Yeah.
happened? That has to be a mistake, but it wasn't.
Oh. I actually, no, thank you so much for that advice. I really think it's kind of daunting when you've been using software like Credit Karma that's available freely, and now your parents are telling you you should get an accountant. So I appreciate it. Also,
oh, go ahead, Mavi.
sorry, I don't mean to cut you off. So I work primarily in the museum field as well.
Mhm.
And I'm not sure if this is a question for you, and just excuse me if it isn't. But I've been told that my student loans after a certain amount of years can be forgiven if my museum is a nonprofit or a federal museum. Is there any insight on that you could give? Or
That I would have to look into a little bit more.
Okay.
There are a lot of different programs to get some loan forgiveness, or there are programs where your employer can pay portions of student loans or future tuition dollars for you. It really depends, but yes, they're out there. So if you're hearing that, certainly ask the HR department for a little bit more information, because that could be a wonderful benefit for you.
Absolutely. Yes. Thank you so much. I appreciate it.
Yeah, sure. No problem.
Yeah, that could be absolutely huge. Barb, you've heard a variety of complex questions from this group. I have to say, these are some of the most complex questions we've had on any of our forums. So kudos to all of you. Does your, and I know that this is not a sales call, but does your firm, because there's a demand for services here, and you have a very reputable firm. Is there a way that your firm can help these folks, Barb, or you can help them, or should they?
So that would be a case-by-case discussion, because I mean, we're always happy to help people. But what I'm also very cognizant of is the fact that my firm does a lot of complicated tax things, and they do bill for them, and I don't have a lot of control over that. So I would be very upfront with people about, you know, potential cost. But if it's something that people are comfortable with, then yes, absolutely, we can certainly help.
Okay.
On the other hand, I mean, to be quite honest, we can't do a tax return for $400 or $500. They, you know, they're $1,000 and upward generally.
$1,000 and up. Okay.
Yeah, generally, yeah.
they're more complicated and.
Yeah, because they're more complicated, and it's also the kind of thing where we're forthright with people. So we say, maybe your situation right now doesn't warrant it, but we're happy to keep the lines of communication open, have a chat here and there, and maybe in a couple years when things are more complicated, you remember us and think, oh, they were so helpful before, let's go do this now. That sort of thing. Yeah.
Well, that's very helpful. And for anybody who's looking, I can also provide some names because it is important to have the right match for what your needs are, your tax needs are specifically, like Barb is saying. So Barb, as usual, that was so fabulous. I always walk away so much smarter after a conversation with you.
Very kind of you.
We're very, very grateful for you spending time with us tonight and so generously sharing your expertise. And for anybody who wants Barb's contact information, you guys know how to reach me. I can send it to you. And we just want to thank you again, Barb. And if anybody has any, I know Barb, you've also made the offer to, if someone has a burning question, you can email Barb, and if she can help you, she will, or she'll in the right direction. This tonight was recorded, so if you want to go back and listen to it, or if you want to send it to any friends who couldn't make it tonight, please feel free to do that. We'll be posting it on YouTube, and we'll make sure that y'all get copies of it as well. So, and we'll be doing something fun next month, and we'll leave it as a surprise. We're not going to share it with you tonight. But thank you for joining us. And if Jessica goes like this, I love it.
Thank you very much.
Thank you.
That was very useful.
Oh,
Thanks
I'm so
for
You're
glad.
very welcome. It's nice to meet all of you.
Yeah,
Yeah,
thank
so it's
you.
great to see you all. And you all know how to reach me if you need me. All right. Good night,
All right.
everybody.
Thank
Good
you.
night, everyone.